Hello, I'm John Atkin. I'm the Chief Executive of the Trust Company, Australia's oldest independent trustee, with offices here in Australia, New Zealand and Singapore. At the reported line, we announced a profit of 4.1 million, which is actually down on the prior corresponding period. We'd foreshadowed that in our announcements earlier in the year, and that was to a range of largely one-off factors. The revenue actually was up 4% due to the strength, particularly in our corporate area. Our expenses, however, were up 11%. Again, that's where a number of the one-off factors hit us. The fact that the expenses went up at that rate meant the EBITDA overall was down 20%. We've reduced the dividend. We're now paying out 100% of the reported NPAT. So the reported NPAT having come down, our dividend has come down to 12 cents a share for the half year. We have a very strong position in corporate. We're the only trustee licensed to provide corporate trustee services here in Australia, New Zealand and Singapore. We've been working that regional network very hard. We've been cross-selling to our clients over that area, and we're seeing more and more take-up from our clients. The standout success for us in the 6 months was our role for Ascendus on the IPO of the Ascendus Hospitality REIT. It's a REIT which holds assets here in Australia and around the region, but is listed on the stock exchange in Singapore. We're providing trustee services on an end-to-end basis, and the response we've had from our client, Ascendus, and the market generally is very positive to that integrated service. Personal is a very old and complex business, and we've always foreshadowed that it will take some time to turn around. We've been focusing on a number of key areas. First and foremost, Ray Gould has reshaped our management structure and made it much more client-orientated. And we're starting to see the benefits of that in the responses we're getting from our clients and a much stronger growth orientation in our people themselves. And we flowed that right back into their KPIs in their own performance plans. At the same time, we've done some really good work restructuring and strengthening our investment management capability and doing that on a consolidated basis across Australia and New Zealand, bringing to bear what we call our sleep at night philosophy. That's been really well received by everyone involved, both internally with our staff and most importantly with our clients. It's also seen positive funds flow into all of our major funds, and our share imputation fund is now ranking in its performance at the top of its peer group. At the same time, Simon Lewis has led a major project over the last 2 years to reorientate our work in philanthropy, bringing out what we call our engaged philanthropy model. That's getting increasing recognition in the sector, and similarly we've had a positive funds flow into our philanthropic business during the 6-month period. So while personal is taking time to turn around, we always knew it would, and I'm confident the strategies that Ray's employing are getting good traction with our clients, and you can see the particular improvements in investment management and philanthropy coming through and supporting that overall thrust. New Zealand Personal hasn't had a good 6 months, and there were a couple of different factors for that. First, it lost a major client really is in the aftermath of the licensing regime there last year, and secondly, it's had to bear this 6 months quite a few separation costs as we completed the separation of the business from Suncorp, who we bought it from 18 months ago. So New Zealand hasn't had a good 6 months, but it's got a great heritage, great market position, and I'm very confident bringing to bear some of the approaches in terms of client engagement that we've actually got here in Australia, that we will bring through a solid performance in New Zealand. One of the projects that's been running in the background now for 12 months has been the review leading to an upgrade of our systems. Our systems are old and we need to invest in their upgrade. We've been going about that in a very careful and professional manner. We've evaluated our preferred vendors and are now at the stage of detailed scoping and planning. We want to get the implementation plan right, we want to control the costs, and most importantly, we want to integrate the work there with our overall strategic priorities. And that's what we're focused on right now. Key priorities for us in this half are to continue the work on the corporate group management under David Grabin's leadership, leveraging off the strength we have across Australia, New Zealand and Singapore. Secondly, we want to continue the client engagement and drive for revenue growth in personal, both here in Australia and in New Zealand. Coupled with that, we are undertaking a profitability review for particular service lines within personal, both here and in New Zealand, so that we make sure we're focusing in the right areas to drive that improvement. And then finally, to conclude the work in our planning and costing of our systems upgrade, so we align that with our strategic priorities. Yeah, the business is going well, and we expect to see steady improvement in the second half because we'll be free of some of those one-off issues that have hit us in the first half. So we're projecting that our EBITDA in the second half will be broadly in line with the normalised EBITDA from the first half. The dividend for the whole year will be in the order of 27 to 29 cents, which is down on last year and is down on guidance we'd given previously. But the reason for that is we've actually changed our assessment of the level of recoveries of certain corporate transactional fees, and we're confident that we'll achieve that guidance.